So you mind if I kick it off, James?
Please.
And then the floor is yours for most of the time, of course. So I want to welcome everybody to the Columbus chapter of CPCU sponsored WebEx today, Zoom, whatever you want to call it, virtual meeting, educational opportunity. We are lucky enough to have a gentleman who has got a tremendous amount of experience and works with a lot of other people with a tremendous amount of experience around the flood insurance topic. And he's going to be talking with us about the opportunities and things to consider in getting into the flood insurance market, and maybe what you'd miss if you didn't get into the flood insurance market. So I'll introduce him in a second. Just a reminder, if you didn't hear a second ago, we are recording this session. Everybody, by clicking the link of accepts that. We are scheduled to run until 1:15 Eastern time. And we will allow time for Q&A, and you're welcome to put those in the chat box, and I'll make sure James gets those as we move along. So I don't want to take any time away from James. I'll just do a quick introduction. I used to work with his colleagues for a couple of years at Milliman, and so I have firsthand experience with the expertise from an actuarial standpoint and a risk management standpoint of the flood exposure. So I got to witness that firsthand. Unfortunately, I didn't know James when I worked there. We didn't overlap, but many of the same colleagues are still there. So James leads the selling of Milliman's pre-built property solutions that focus on private flood insurance, insurtechs, and commercial auto telematics. He's a researcher and an author of several white papers and ebooks on leveraging insurance business data and building business models. He's a passionate and frequent speaker at a lot of industry conferences. You may have seen him before, which include IASA, Analytics for Insurance, Casualty Actuary Society, RPM, which is I love that conference, Society of Insurance Research, AAIS Main Event, and Insurance Canada Executive Forum. He hails from Toronto, so this is great. We get to share with our Canadian friends, which we're unable to see. And without any more blabber from me, I want to turn it over to James and talk about the private flood insurance opportunity.
Perfect. Thank you so much, Dale. That's
My
just
pleasure.
A great introduction. Are you able to see my screen okay?
Yes.
Yes.
Let me just do a screen.
I forgot to add, if everyone doesn't mind muting for obvious reasons.
Are you seeing the full presentation, or are you seeing these slides? Are you seeing the additional stuff?
We're seeing the slides in your notes below.
I'm not sure why this.
There we go. Now we just see the slides.
There is a better way to do this, but anyway. Okay, so I'm delighted to be here with the CPCU to discuss this, and I'm delighted actually we have a slightly smaller group so we can get into some of the meat of this, because my view is that flood is a newer kind of risk, and we've heard lots from. I'm an engineer by training, and I'm in a group of actuaries, and there's lots of actuaries that focus on this, and my team really specializes in that. The underwriters haven't heard as much from, so I'm delighted to have a conversation here with people who think about growing business and placing risk. And I think it's important that the underwriting part of the conversation be strengthened as we look at flood. So we'll have a discussion today, and we'll keep it pretty interactive. You're welcome to pause me at any point with a chat, or if you raise your hand online, or just turn off mute and say something, we'll stop and have a conversation. And if you don't stop me, I will stop and ask a few questions. So I think it's going to be interactive one way or another. So if you've got a question, don't be afraid to chime in. The agenda we wanted to discuss today that we had planned for is really, what is that opportunity to get into private flood for insurers to do that? And then flood has been a bit of an ambivalent market. If people are hesitant to get in, why are they hesitant? And we have some research on that, and we'll also try and grab some input from this group as well about what you think those hesitations might be for your organization. What does that recipe look like to get into private flood? What is really needed? I'll lay out what I and the rest of my flood expert team really see as those crucial elements. And then finally, what are the resources available to look more into this area and to delve in further. Just as a bit of background, I'm relatively new to flood, so my team would cringe if they heard you describing me as a flood expert. I've been at this for all of a year. However, I'm absolutely a P&C data expert and have been doing that for a couple of decades and have helped many companies sort out their strategy to compete with data. So I bring a lens of not just actuary and underwriting, but also marketing, executive operations, channel to the table around how this fits. And you'll hear me in my descriptions today at times try to step back from the immediate focus of flood and see it in the context of what else is going on with an insurer and their strategy. So what is the private flood opportunity? Well, from my perspective, I think there's really three areas that I think of when I think about the flood opportunity. The first one is financial. The P&C market in North America is largely flat compared to other parts of the world and other financial lines. However, the flood part is one that can add, on the order of 50% more to the homeowner's book nationwide. So this is one where there's a big financial upside to do that. And in addition, there's some good margin upside. There are a lot of lines in P&C which have been around for a while. Commercial auto comes to mind. And you need to be careful going into long haul fleet. This space is a newer space. It's one that the pricing, you can see 200-300% swings in pricing on the same risk. So there's an opportunity here to actually make money. If you've got a good way to think about risk and price it, you can actually make some good coin here in a way that is hard to do in some of the more mature lines. The customer side is the other part. Well, first of all, we were talking about this a little bit ahead of the opening today, but what does it mean to do climate change if we don't address flood? What does it mean to cover our home if we're 5-10 years down the road and exclude the biggest peril? I think that if we're really thinking about serving our customers, we're going to need to do that. And if we think about it from a community perspective, flood can wipe out an entire town. And it isn't always in the places where people expect it to happen. With the amount of moisture in the air and the heat in the air, it can come down in a big hurry. And flood or mudslides, these things can have huge differences. And then you could be in California and have a mudslide and then have that make the fire more likely. So this is a space where if we want to treat our customers' communities well, we need to do that. And then the share of wallet is a big issue. Like if you've got a customer, Progressive has made public comments on why they got into this kind of space and why they're getting into homeowner space, and it's around share of wallet. So I think that's another lens for thinking about doing the right thing for the customer, also making money in this space. And the last reason I'll say is around product, that sometimes people get into private flood because they want a superior product. So for instance, they might want one that's easy to start. So there's no waiting period. There's no elevation certificate required. Or they want higher limits. They don't just want a minimal limits offering. They want one that's going to fit their target market. And maybe their target market is a little bit better to do and wants full coverage. Or better terms, like, can we get replacement costs on dwelling and personal property? Or can we get resilience coverage so that if we flooded once, we're building back with better flood resistant materials? Or can we get a single deductible? Why does it have to be so atomized? So those are all reasons that people get into it, to put a better product on the table, to grab better dollars, to also respond to customers. I'll just pause there for a moment. We got some smart people on the line here that have seen a lot of stuff. Any other reasons that you can think of for wanting to get into flood, or anything you'd want to comment on based on these from what you've seen around property or flood coverages? Okay, let's go on to the next one. So that's the upside. I think it's equally important to think a little bit about the downside. And so if you don't offer private flood or offer flood coverage in some way, what's the downside of doing nothing? And so one way I like to think about it is, well, if you have no flood product, clearly you've got no financial opportunity, but it's in the long run, it's probably going to hurt your homeowner's book, because I think it's not going to be looking, shiny from an offering or a statement about the company if we're 10 years down the road and flood's still being excluded. I think by then it's going to look pretty funny. Secondly, you could go down the public offering, and many people do. It's the largest part of the market now. I think it's on the order of 80% plus or minus of the coverages that are out there are the public offering. And there's some financial opportunity there, but because it's the public offering and everybody has the same public product, it's hard to differentiate. It's the NFIP, so everybody has that offering, and the terms are consistent. The third option is you could go with somebody else's product. And if you go with somebody else's product, there are financial opportunities, and there might be a little bit stronger ones depending on what the book looks like. And the competitiveness, you could have some competitive differentiation, but it really varies. So you could have some competitive differentiation that might work with you. I'm just conscious, we spoke to a company recently, and I'm not going to share who they are. So for that reason, I can tell you a little bit about their story, but their experience was they had another product, but the product itself was a kind of product that focused more on underwriting and didn't have a stable actuarial basis for looking at the risk. And so the risk appetite would change frequently, like dozens and dozens of times. So now all of a sudden, how can you sell when the risk appetite is changing? And if you're the MGA, you're not driving that. So it can leave a pretty funny taste in your mouth. And especially, as I said, when the market can be fairly volatile, they can be fairly big swings. You could imagine that how you're competing could change dramatically if your pricing is not stable over time, because you don't have a stable view of where the losses are heading. So let's talk a little bit about some of the reasons that insurers don't offer private flood. And here I'm going to pull some information together from the Alabama Department of Insurance, and they hired us to do some work and go out and survey the market and talk to various stakeholders that were considering private flood. And they asked the question, they wanted to get a sense about where their market was specific in Alabama, but maybe these things have some applicability beyond. We can discuss that today. But I thought it might be a helpful way to gather input from this group on what you think. So if I was to bring a private flood offering, or somebody else would, your reinsurer of choice, brought a private flood offering to the table in your company, and you were wondering what the pushback might be, what kinds of reasons would you expect to hear? So I'd like you to put that into the chat here, if you could. And if you could just take your 3 items that you think you would hear pushback on most in your company. So maybe it's A, B, and O. If you could just type A, B, and O into the chat, that would be great. And then I'll just summarize those up. I'm just powering those up now. There is polling in Zoom, but I hadn't used it before. It wasn't quite as clear how it was going to work, so I'm going to do it manually here. I know that's going to work with this size group. Okay. I think we'll close that now, and let me just share the results, first of all, from the results from the survey itself. Are you able to see those now? Are you seeing those results? Just nod.
Yes.
Perfect. So here are the results that came from the overall survey. And let me just come down and we'll put yours in here. And I will fill these out and send them out to everyone. I'm just going to put the top ones in here. Okay, I'm going to call that done because the other ones are ones. And if you placed a 1 in there, then that was you, and you can add it mentally in your own list as one of the smaller items. So when I looked at the overall results and looked at where the data started to have a bigger breakage, that's where I colored things differently. So I saw that the weighted average and the numbers that were very significant or critical started to have more divergence between F and P of the big data. So I said the most significant ones are the 4 red ones. And at the bottom, I saw the yellow start to have more divergence here. And actually our results are a little bit mixed. So the 2 of the biggest items were in the red ones. So that's very consistent. And then we highlighted some of the other ones that were pretty particular. And by the way, that can be absolutely right, that an organization is very focused on a couple of things that really matter to them, and it might not matter to others quite in the same way. So I think we highlighted the volatility, the flood risk, the repetitive losses, implementation costs of a flood product, litigation risk, lack of agent expertise, and reputational risk. Interesting mix. Did people want to ask questions on any of that, or comment on that in terms of these potential concerns for getting into flood?
Jim, this is Carol Blaine. Can you hear me okay?
Yep.
So I thought it was interesting that most of the people on the call today have some relationship with an entity that might be concerned about its reputation. I spent several years with Nationwide, and I know that protecting that brand was very, very important. And for the longest time, even though my product group was comfortable with it, they would not allow us to extend coverage for sexual molestation accusations for particular product that insured coaches, for example, of young people's baseball and football teams. So it's interesting that that's nearly the bottom for the department, or for, you said this was a survey through the Department of Insurance of Alabama. Did I get that right?
Mm-hmm.
Yeah, so I think that's interesting. I know it's not the highest level, but I was one of those 2 that voted for that, because just putting myself back, thinking about when I worked at Nationwide. Do you think that's a real risk? Or did I and whoever else voted for that overinflate that risk? What is your thought on that?
Well, I'm sure one of the actuaries I work with, Dave Evans, is on here, so I'm sure he's cringing now as you asked me a risk question as somebody who doesn't have a risk background. My personal take would be that there's objective views of risk which you can measure, and then there's this gut and cultural sense of risk and reputation, and those two things don't always line up. It's not to say what you'd say with objective and measurements is right, but I think sometimes the cultural stuff, what's the right word? It gets overweighted. I'll tell you a story. So a customer, an organization that I know well, it has been a customer of mine we spoke to, and they are one of the dominant players in a region. And they were looking at this, and we were talking to some of their top people. And they said actually we had another product that was new and that had some exposure, and they went to market, but it wasn't with something that had a good lens of where losses were going to go, and that product blew up and they unwound it. And so your reputational risk was like front and center. So they were thinking, well, how could I get into this, James? Because wouldn't we end up doing that again? And I'm sort of thinking, well, it's a possibility, it's a concern. We haven't seen that when you do it well, but you could. So I think sometimes the history and the fears end up dominating more than what's needed. I think some of it's just a momentum play that people in past, it was considered too risky. And then when the CAP models get good and the ability to be hyper local and grab good data locally gets much better, this is a risk that you can really manage. Like it's very, very doable, but the mindset takes longer to get there, I would say.
Yeah, I know Nationwide's concern was always being on the front page of even, I guess now it would be a digital media post about not handling or representing, in that case, someone that was accused of SAM. But the flood would be the same thing, that no, this claim wasn't covered, and now we're not properly protecting against flood, or whatever the accusation is. So thank you. That's a good. I think you're right, because eventually, even the SAM exposure was eventually put back into the coverage, was added back into the policy. But I thought that was an interesting reason for taking it out to begin with, and I could see some entities having that concern about flood as well.
So,
go ahead, Dave.
Yeah, hi, thanks. I work with James at Milliman. And I actually think, Carol, that you're kind of, like, I agree with what you're saying, and I think that's actually why the risk scored low, is because in the case of flood, not offering it, you have that risk, as we saw, like with Katrina, on the down to the slab claims from the major carriers, that they were in that position where you're saying of this claim wasn't covered because they didn't write flood. And so they understand that. And then also I think that when you're a write your own carrier, you're also, even though it's the NFIP product, the insured can see that as yours. And those coverages are limited by statute and limited by Congress. And the claim settlement is difficult with the way the forms are. So you still kind of have a reputational risk there, where they'd be like, well, I had a flood claim with, I don't know, I think Nationwide does WIO, I'm not sure. But assuming they do, you'd say I had a flood claim with Nationwide, and the loss settlement was really weird and it took a while and I didn't get coverage for this and that, when really that's an NFIP issue, but the insured would see it as your issue.
Yeah, thanks, David. That's very, very helpful.
Any other comments people wanted to make about hesitancy? Because I think in some ways this is where the game is at. I like talking to underwriting and salespeople because we focus on the big things. If we're thinking about flood, one of the big things is just the uncomfortability around it and nervousness about it. And, can we have a good conversation? So I think of this as really a crucial part of the discussion. And I'm glad underwriters are in this conversation today. So Anything else that you wanted to bring up, another example or something that's haunting in your memory of what you've heard or could imagine hearing?
Michelle, did you want to jump in?
Okay, let's go on then. Thank you for that. So let's talk a little bit about what a recipe might look like to get in. So we've talked a little bit about what some of the upside is, financial, customer, product basis for getting in. We've talked a little bit about what some of the hesitancy could be. So if we weren't going to do it, you know, what would be those nervousnesses that would take us out of play? Let's talk a little bit about what that recipe might look like to get in. And obviously, you know, if you look back, you should see some fit between that recipe and some of the things, like some of the top red items that people were hesitant about were around risk and pricing and volatility. And hopefully you'll see when we talk about a recipe that works well, that this is a very doable product to be able to assess exposure and manage. So let's talk a little bit about what an overall recipe might look like to do that well. So it probably won't come as a surprise to the folks on this line, which on this call, which seem like you've been around and seen these insurance things. I think the keys really are people, process, and technology. So that's not a new way to frame it, but the key is, you know, what do we put underneath here? I think I'm going to start with the technology, not because it's necessarily the most important, but because it's often one where people start. They think about the hard building blocks that are out there. So let's start with those hard building blocks, and then we'll talk about the process around it. We'll talk about the people behind it. So when we think about the technology part, you know, what's really needed to get in here, and there are a lot of elements that one can have in trying to get all of your technology together. And in fact, one of them is around having a modern way to price the overall flood insurance product and to deliver a program to the market. Because flood is so local, and you could be on one part of a hill and on another part of a valley and be only 15 feet away, and you could have a completely different flood risk for some parts of the flood exposure. It's hyper local. So how do you get that GIS data that is very specific to your elevation, very specific to where you are and the curvature where your house is, and use that for underwriting and use that for pricing? Because flood is new for many people and they're just getting in, and so we don't have 20 years of data that the actuaries would love to have. You know, having market baskets that are a notional representation of everything in the market, and then being able to look at those notional representations and kind of use those market baskets as a proxy is very important. Being able to see what the profitability will look like and what the competitiveness will look like, especially given that the risks are changing, the competitors are changing, the government is changing. So all of those things require a good foresight into what those profitability and growth equations can look like. And then finally, if you want to get into the admitted market, you know, you could have 50 states and 50 different conversations potentially, or almost. How, if you're trying to get into the admitted market, are there ways to rapidly get in that can get past that? And there are products that can help with all of these. And from our perspective, these are some of the main building blocks. Now, obviously, you don't need to have pre-built solutions. I mean, we have some. There are other players that have some of these in the market. But from my perspective, I think when people think about a flood overall program and to be successful with a business model, top leaders are thinking about a car, and they're thinking about how does it fit with the other vehicles in their fleet, and does it really work? And oftentimes I think that we end up seeing all the pieces, and it's easy to it's easy to see the pieces you have that work. It's easy to see the bump you have and say, that we tried something before that was similar, or maybe we tried flood once before. Let's fix that bump. And now all of a sudden you're planning to just quickly go and grab those things because they're near hand, and that one has worked for another part of the business. So why wouldn't we just use it? The challenge is, how many parts do you really need to have 3 years from now if you've got a really successful flood program? How many parts are there, and are you wise to cobble it together? And that build versus buy decision, I know in my history of working at PNC around data warehousing and get all business data together, that we do not do a good job of that in PNC between that build buy discussion. And I'm not sure we do a really good job here either. I think it's easy to fall into a build with the people that are there, and as soon as people think about a flood coverage, somebody's going to get out the paper and Excel spreadsheets and start to think about how we couldn't extend what's already there. So just having a sense about what that full answer looks like, and then what the impact is of delay if we're waiting to build that out over 2 or 3 years, or we could have it going in 2 or 3 months. What is that opportunity cost? I'm not sure that gets fully baked in real well, but I think it's worth looking at. And I think it's worth asking about having pre-built options, because I think the way we think about risk and some of those hesitations can be quite different if we have a path that is well understood, that others have used, that is designed to be configurable. So I would encourage people to think about those, whether it's us or somebody else, but just think about more pre-built options. Don't assume it has to be custom built. Any comments or questions on that? Yeah, I think the custom built and starting with less technology is not so much a business case option that people take. I think it's more of a default that they fall into. It's not that the business case to build it is better. It's that we plan on building it for whatever reason, and the broad options really weren't looked at from us or others. I often think that's true in PNC. And if you're a big enough shop, I understand why that is. So if you're a global top 10, I understand why that culture is going to get there. But it might not be the place you want to start if you're doing something as new, as volatile, that's changing as much as this is. So what else matters in the recipe? Let's assume we've got the technology together. We're either going to buy it, or we've got clear plans to build it, and it's in our wheelhouse to be able to build it, or a mix. What else matters? I think the process really matters. And in this case, I've taken content from a Milliman offering, and I'm not going to walk you through our offering, but I wanted to comment that if we're thinking about the process to understand addressing flood and getting a program together, the first step one takes is really crucial. And so I wanted to highlight how to do a really good job of that first step of assessing what the options are. So let's assume, we're looking at a carrier. It could be a national, it could be a regional, it could be a very specific niche-based home insurer. It could be an MGA or insurer or a reinsurer, a startup. So, what is that organization? What are those business objectives? And then we can look at the goals. Is this designed for growth? Is this designed for profitability? Is this designed to really own that customer relationship and do a good job? So understanding those, understanding the options. What does that public option look like here? What does another private option look like from the reinsurer that serves this insurance company? What would a private option look like from Milliman or from another third-party offering? How can you assess the overall the approach? What would be the take-up rate? What would the competitors look like? What would be a pro forma profitability statement for this business? And if there's reputational risk, how material is that? Can we quantify it? And then evaluate and recommend that. Now, one could go away and hire a big six organization, and maybe this would be 3-6 months with price tags commensurate with that. I actually prefer a good study to do these kinds of fast start services that is smaller, that has the best experts you can find, and do it in 2 weeks, do it in 3 weeks, and have them come back and say, I expect you on our behalf to give us the best plan for putting a flood product for my insurance company that could be done. And by the way, and if we hire you, Milliman, to do that, or hire another outside expert to do that, and you don't do a good job, we're obviously not going to buy anything from you in terms of additional services or products. But for us, this is kind of a win-win kind of scenario, because for us, nobody makes a lot of money trying to sell services for 2 or 3 weeks. But if you do a good job, you can set the customer up to make a really, really good decision. And so for us, I think this is probably the highest value offering that we have in our portfolio, or you could look at others. But I think getting that first step and assessing that well and knowing those options is really crucial. And I don't think there's enough attention paid on this. And we've invented this offering just recently. It's not going to be a revenue item for us, but I think it's really important as a customer service to do this well. So I'm a big believer in this. I've seen this elsewhere to do other challenging tasks, and it's helped a lot. So we have done things like this in the past, and we're pretty hawkish on this as a process step. And if you can find, really good flood experts in other places to do that, I'd recommend it. But thinking through those steps, especially the very first step when you're going into something that's challenging, I think is really crucial. I'm going to pause there and take any questions that you have or comments you want to make. Any reaction to that in terms of that first step process, or how process works overall for flood? And obviously we have methodologies and stuff that apply to other parts of flood. I could have laid those out, but I thought it was most important to think about the very first step, because a lot of people are a bit on the sidelines and not quite sure how to enter. So thinking about that very first step well is I thought, the best use of our time here today. Okay, we'll go on. So the last thing I wanted to comment on is the people involved, and I think we were talking to an organization that has asked us to partner with them, and they also sell actuarial services in this space. And we were talking to them about all of our technology, and they stopped us and they said, listen, we don't bet on the horse, we bet on the jockey. Talk to me about your people. We want to meet them and hear and discuss some of the bumps that they've seen and their experiences. So we did that. And that I thought was very, very interesting. So from their perspective, they thought the people mattered a lot more than the products did. Mind you, the people here in our situation created our products, but I think the people are really, really crucial. Do they understand your business? Do they have the right experience? Do they have experience that is broad enough? Because have they seen the insurer, the MGA and startup space? Have they seen the reinsurance space from a flood lens? Have they seen the various state regulators, and they can be quite different? They've seen the national regulator, and that makes quite a bit of difference. In this case, FEMA has said that they are making a transformational leap with Risk Rating 2.0, which is happening scheduled for October of this year. So does your organization have experience with the national folks? Depth and quality of experience. I think about that around solution design. So as I say, if you know one insurance company, you know one insurance company. They can be quite different. Their culture, whether they're underwriting focused, actuarial focused, channel focused, marketing focused, analytics focused, like a Progressive. How you do solution design can be quite different depending on their culture, their leader's vision, their business model, and how well you fit that solution to that specific insurer. And then the issues, I think, can be really helpful. One of the things I like best, the best insurance meetings I have seen, is when I walk in, and I'm a sales guy, I walk in and the insurance person folds their arms and basically says, what the hell do you know about that? And then the next sentence might be, let me tell you the 10 things that blew up for me in this space, or 10 things we couldn't get done here. I think that's hugely helpful, because now you know where the issues are, and you can have a real conversation about whether you've seen those, whether they're a necessary problem, whether you can get around them. But now you're having a fierce but real conversation about what's at stake. So for me, I think it's really easy actually to suss out the experience of folks. I think half-hour conversation with 3 organizations, and you would know immediately which of those 3 organizations you think knows the most about this, and you'd be right almost every time. But as I said, that assumes that you actually talk to 3 different organizations. I think it's highly advantageous to do that and not just fall into stuff that's nearest to hand. So a success recipe, I think, for private flood has 3 main components. Technology, I think it's helpful because people are trying to go fast. There's just a lot to get done. And the exposure is real and it's not getting any smaller. So having some pre-built options is helpful, but certainly you need options to address modern pricing based on CAT models, because nobody's got enough history to see enough losses easily to manage it. So how do you get that together? Hyper local GIS information so that you can be very specific to the risk at hand. Notional data so that you can test your profitability and competitiveness, especially for places where you don't have, where you're going in new. Ability to get regulatory approval if you're going to go for admitted markets. Processes to be able to both plan and execute your flood program. And then people, making sure you've got the A-team, and whether that's internally, whether that's externally, whether it's a mix, but just make sure you're comfortable you've got the best people you can get, especially early on when you're planning it directionally. I think it's one thing to start to, carve out and bring in other folks, but I think early on, when you've got a market that is not very mature and you can have wildly varied prices, and you're going to see a whole bunch of change both on the risk side and on how competitors and pricing works in the market, you really want really good people in this. So I think those are the 3 keys that I think you need to get going in the business. There are other things that you need for any business, like capital and a channel strategy, but I think these are the 3 peculiar ones that, if done right, this is a very doable thing that can add a lot of revenue and margin to the table, and help your reputation and your share of wallet with your customers. I think there's a lot of good upside here if people can find ways to get into something that's new.
So Jim, I have a question for you, and at least one other person on this call can relate to this. Before I joined the Institute a few months ago, I spent 9 years creating and teaching risk management and insurance to college students, not all kids, but some that were right out of high school. And when we started talking about what's an insurable risk and how there are these different plans that help with those risks that are not deemed insurable, things like FAIR plans, et cetera. The flood risk and the NFIP program was the classic example of how the federal government had to step in because it wasn't an insurable risk. And I know you said early on that 10 years from now, you'd be surprised if all homeowner policies didn't include the peril of flood. And with global warming and all that we're seeing about rising levels of our oceans, et cetera, what has changed, or what do you think will be changing that will make this peril something that the insurance industry will take on and will see as an insurable risk?
I'll give a quick answer and then I'll ask Dave to chime in if he's still able to do that. My quick answer would be the ability to use modern catastrophe models to project out losses has come a long way in this space, both for inland flood and storm surge. And so using those models and the comfortability for the industry and even the regulators to start to use those models has come a long way. And secondarily, the ability to bring in GIS stuff so that you can see hyper local information on elevation for this building and exactly where this building is in 3 dimensions. I think those 2 things have really changed. And so when we think about a flood, writing a flood policy, we're not thinking about the way, we underwrote a home early in our career. This is a different kind of animal. Dave, do you want to add in on that?
Yeah, I think it's probably a few things coming together. I mean, it's what James said, and way better modeling that's improved vastly even from 5 years from now. Now carriers have 5, 6 options and lots of other data vendors out there that can help not just with the risk at a location, but the risk profile of properties and getting past things like needing elevation certificates, which can really hinder customers from wanting to get flood insurance. But also just awareness, partially from like climate change, like you mentioned, events like Harvey, I think were kind of a wake up call with a lot of flooding outside of traditional special flood hazard areas. And then I think some regulations really helped, like companies being able to offer products and still be write your own carriers is new. Acceptance of loans or private flood by lenders. I think that is very key, and we wouldn't be where we are today without it. So yeah, I think the modeling is very important. The other piece is reinsurance. A lot of reinsurers are out there driving the appetite for this, and many carriers would not consider it still if reinsurers weren't out there. So I think a few of them really support the market, and they started doing that with the NFIP back in 2012. So between reinsured appetite, modeling, regulation changes, and increased awareness, I think everything's just pushing for more offerings and hopefully more take up.
But it sounds like there may still be properties or geographic areas that will perhaps still be uninsurable, that will still be funded by the NFIP, or do you see the NFIP really eventually disintegrating because the private insurance space can handle all of it?
I think there will always be a need for a residual market, and there will always be companies shying away from areas and properties like you mentioned. Specifically, there's severe repetitive loss properties, which just, if an insurance company knew it was there, they couldn't insure it because those homes have claims worth their value over a short number of years, and it's extremely predictable. It's about the definition of uninsurable. But also some companies just aren't comfortable, even in the high risk area where they are insurable, they're just insurable at a higher risk than a company wants. So you'll still have the NFIP out there. I think with what the NFIP is doing with risk rating 2.0, that they're protecting themselves from having a financial issue as more companies come in, and they still have to take all comers. So I think it's important that their rates get to a good level and a good level of accuracy to do that. But that, well, we obviously think they are, but I think that's a key element, so that even as more companies come in and they have to accept everybody, they can stay financially viable.
And Roger, I know you made a comment before most people joined that this is an area of interest to you, and that you had a few years back put together a panel on this topic. So, and I don't know how many years ago that was, but are you hearing things that align with what your panel was going to present? Or are you hearing new things or different things? I'm just curious about your perspective on this conversation.
I think that pretty much the presentation is tracked with what we were going to cover, with a lot more detail on how to get it done, rather than should it be done and can it be done. And again, the presentation was intended from the personal lines interest group, and so it had an expected personal lines taste. So what we just said about the homeowners hits right at that nail also. So I'm very happy with what I've heard today.
And how long ago was that, Roger? A couple of years or longer than that?
Just 4.
4 years. Okay.
So.
When I don't mean to hog the mic, so anyone who I'm watching, if somebody else unmutes, I'll stop. And Jennifer, go ahead, please. I guess my mind goes to other uninsurable risks, and will these same pressures, or not pressures, but these same increase in information, better modeling, the use of GIS, does Milliman see other similar situations becoming equally interesting to private insurers?
Do you mean like other perils?
Yes,
Outside
I'm
of
sorry, I
flood?
probably said the wrong
Yeah.
word. Yes, other
No, no,
perils.
that's clear. I was just making sure I understood. I mean, yeah, these are all tools that are being leveraged more for other perils, like a lot of coastal riders. You know, a lot of your coastal flood is very related to
Mhm.
your coastal wind, and they are implementing, you know, more GIS, better modeling, more granular rating. That's all happening. I think it's just kind of less of an impact and an opportunity because it's a marginal opportunity to improve your current book versus getting a whole new source of revenue and customers that you're not doing today. But they're definitely doing it. I guess another area that would be a good opportunity would be wildfire in California.
Mhm.
I think a lot of surplus lines writers are doing exactly that, coming in, trying to match price to risk the best they can, and taking advantage of the fact that the admitted market players can't really because of the regulatory environment. So I think that might change as the California Department of Insurance looks to see what they can do to encourage availability and affordability. If they let more companies use more of this technology, I think that would be a good opportunity. Maybe less for the companies, but more just for California to get a more functioning market from a availability perspective.
Interesting. Well, since I am with the institutes now, I have to ask this question. Jim, one of the key elements you mentioned was people, and those the key players having the knowledge and the experience needed to ensure that a Write Your Own program is successful in terms of profitability. So leads me to the thought, and Angela, who's I think still on the call, yes, so she has some background in education as well. Are there, those of you who are with companies, or this topic might be of interest to you, what could the institutes or what could universities do to help educate, or dare I say train? I don't like the word train because you train a SEAL, but you know, to enhance the skills and the knowledge of individuals so that it can meet the needs of carriers who might be looking to get into this space? Is this a skill, or is there a set of experiences or a way to teach those who may not be familiar with how to approach a flood risk or underwriting it, or you know, that educational institutions could help with? Or is this, you got to learn it on the job kind of a skill set? Rick, you're with a pretty large brokerage, and if you're able to open your mic, and how would you approach this if you were asked how to educate some people on the risk associated with this and to get them up to speed?
Yeah, let me actually put my video on. Been here for a few minutes. To be honest with the education piece, especially talking about the WIO flood programs, things that are a little bit away from the norm on what we deal with a brokerage, whether it be commercial property, GL, complete package programs, whatever. Honestly, it's a mix between, this is what I'm finding, a mix between either the carrier or even a reinsurer and the broker getting together to discuss things that need to be educated. You know, what's the language look like? What are the legal ramifications? How does this blend in with the normal program? Like I work for Assured Partners. What I'm finding on a daily basis is that kind of meeting of the minds between all of it, between the broker or agent or even an account exec or account manager, and then even a carrier. And the only way you get to the heart of what needs to be taught out there is for all three parties to meet together to find out what's there and what needs to be, what needs to be illustrated to our public more than anything else. That's what I'm saying.
Thank you. I'm just curious about that.
Yeah.
Anyone from the carrier side that might be considering this? Any thoughts on that? Well, I know the Institute has kicked off a new putting some energy behind this whole idea of enhancing modeling. And I'm sure you'll be hearing more about that. And that is supportive here. I also know, though, that maybe I'm a little too close to this, but we're not even able to offer our flood designation right now because we can't get the most current information. And Jim, and you've already alluded to this with the NFIP, the 2.0 rating. So we're waiting anxiously for that, but it is an area of interest. And if there is anyone on this call that might want to think about it, we are open to finding a way to support if there are educational needs or things that we can support coming out of Milliman or a carrier, or as Rick suggested, even key clients or reinsurers. That's our role. And Angela and I just most recently leaving higher ed, we have some access to those kind of resources as well, because I think that people part of it plays right into the whole talent gap that our industry is suffering from, being that young people want to do something that will make a difference. And our industry has a tendency to appear to be rather boring and not very innovative, or not a place that is as attractive as Wall Street. But this kind of a opportunity could really appeal to someone starting their career who wants to get their wants to get their feet wet, so to speak, with something that's new and different. So just wanted to put that out there, that I would love to hear from someone if there's something there that we can work with.
I like, just speaking up right here, I like Maria's question. Jim, if you've got something to answer on that one regarding blockchain. Curious thoughts on that.
Let me just find the question here. Is blockchain type of technology a potential resource in the future for flood coverage? So let me think a little bit about this. So blockchain's specialization is about how do you ensure payments between parties in a way that is not dependent on an intermediary bank or whatever. So how do you do that?
Right, but it also extends to just sharing of knowledge and between different resources. Between using information coming in from the Weather Channel to compare it against your insurable fields that you have, your geographic area.
I hadn't thought about it that way. I'm not sure I have an informed opinion that's worth recording for an answer to that, but it's an interesting question.
Yeah, we had a presentation a couple of years back now about blockchain technology and its impact on insurance, and again, just sharing those types of resources that data from various places that really does all add into your overall consideration, and just it's just an interesting concept, and I'm always curious about hearing how it's used and how others are considering its usage. What about other technology that's coming out now, like drones, does that have an impact on like reducing claim expenses and therefore potentially how much it costs for the insurance?
Dave, Dave is gone. Couple of things. I know he had to drop off at the top of the hour. Certainly, you know, you get a flood and you have a slab left. A drone is a great way to get across and inexpensively and quickly track those claims, which certainly provides some claim service and can help contain claim inflation as things get delayed. In terms of the ability to audit what's going on at a home and inspect, I mean, some of those are on site, some of those can be drones, some of those can be satellites. So there's certainly more data that one can bear to assess from an underwriting perspective or to get involved in an early claim. And all those technologies are going to play a role. But I think a big part is the data and the models too. I mean, the ability to not just underwrite with historical data in a traditional way, but to use catastrophe models, and they're changing really rapidly. So that game is moving fast, and the regulators are shifting how they view that from an old world of send me all the data to we will get shrewder at assessing models and know what a good model looks like. And to the point that, you know, maybe we'll get to a point where there's something like a cap model clearinghouse and states actually follow best practices on what really is a good way to view losses. So I think the data and analytics part of that are going to change dramatically. That those parts we know, and the hyperlocation stuff has been a big one. I mean, being able to see down to 30 meters or 10 meters and grabbing all of that data. So I think the data part of this is going to continue to change the game and be able to price risk more accurately. And I think that's a big part of the answer to Carol's question about an uninsurable risk and why so much of this is now insurable and is something that can be comfortable.
Yeah, thanks. That does make a lot of sense, because I think moving into private, the more you know about something, the more, you know, the more comfortable you're going to be getting in that game.
Yep. So it's not that it's an uninsurable risk. I think that, so if we think about the most extreme risks and say, hey, maybe they're not insurable, Dave's already said they'll be an insurer of last resort. But even within those, in the flood zones, modern flood pricing can be very competitive, and one can make money in that space. But a lot of the losses are happening in places that are outside of flood zones. And so having it might be a small risk, but you still want a small policy on it because you can't afford the downside of losing your entire family's home for the infrequent but catastrophic event that you have local water damage. So I think we're smart to be thinking about this not as an uninsurable risk, but as a very manageable risk. And then what are the layers that we use to approach that? And I think Rick's discussion about how do you get the reinsurers, the insurers, and the producers on the same page and having a conversation. And I think that's exactly the way to do it. And then I think you would want those three keys that I talked about as part of that conversation. How do you think about the technology? How do you think about the right people? How do you think about the right process? And then what is the right business model for those three partners to attack it? I think it's that work that needs to get done.
So thinking about everything that's been said and knowing that Roger was going to talk about very similar topics 4 years ago, and a minute ago I reiterated what you just said, Jim, about 10 years from now. So, and then Dale made a comment in the chat that it's going to take, there's a player out there that's going to hit this hard and make a killing, whatever that might look like. Makes me think about Root for auto and the $1 million they raised, even though they're not making money yet. Where are we in this cycle? Are we at the beginning of this, of the write your own being a very viable and important part of what insurers will be doing in the property space, whether it's personal, commercial. Are we well into the cycle and it's just a matter of a couple of years before some major players get involved? Or are we still really 10 years away? Any sense of that?
Well, I would love Dave to chime in on this too. I'll give you my sense, and he would obviously add a lot more to it. But here's my take. We saw some great data from I think it was from the Insurance Institute, that looked at flood, the number of flood riders being offered, and they saw the number of those double one year to the next. And I think that was 19 to 20, if I remember what that is. And when we summarize and I send it out, I'll actually give you the actual quote for that, so you've got the real data. So I think we're seeing strong growth. We're seeing major players going to market. Some are planning 50-state rollouts. We've seen some others more focused to look in to start in one place. We've seen some that are very much trying to build it based on their own components. I think we're in the early stage. It's not commoditized, but I think we're in a state where people are getting in, are driving revenue, are driving margin, and because the opportunity is so big, it's a ballpark half of what the property market is. It's not going to sit there untouched. It is going to be attacked. It will be captured. It will be managed. So I think there's a recognition. It used to be that people debated this. Now it's not really a debate. It's just a question of how fast. And I think, which is your question. And my view is that in the next couple of years, we're going to see tremendous growth in the flood market in terms of coverage, in terms of its acceptance. And some of it is an acceptance issue, just at a retail customer level. If you don't have to buy flood insurance, will I pay $100, $200, $300 on top of my property to get what is maybe a low probability problem, but I want to be able to sleep at night, I'm going to add it in. And I'm wise to add it in. And my real estate agent says so, my insurance broker says so, the media says so, and we're not, we're having a data-driven conversation. It's not just a thumb in the air. If I don't have to, I'm not going to buy it. It's those bad insurance companies. Like, that kind of mindset is, I think, going to diminish. One thing I'd like to clarify, we've been talking about private flood as an offering, which is different than Write Your Own. So the Write Your Own, of course, would be through the FEMA government offering, and that's the government's program. That's one way to go at it, a valid way. We're really talking about coming up with a private offering that is different, that is using modern tools that would fit your appetite, that you can control, that you could wrap around your homeowners and have consistent coverages that would fit the target demographics. So we're really talking about your own customized flood offering, starting with maybe it's our products, but maybe it's somebody else's products, but a private offering separate from Write Your Own.
Hey, this is Dale. I had made the comment on the chat about some company diving in first, and James, you had mentioned Progressive, and that's kind of what got me thinking. I could see them very much so being the picking off the low hanging fruit. They purchased American Strategic Insurance, which is a very successful property insurer in St. Petersburg that started as being a takeout insurer in Florida. Have some extremely intelligent people that created a monster that is nationwide, basically, in homeowners coverage. If I would be more surprised if they don't do it at some, being one of the first out of the gate. And like you said, the add-on for, even HO4s to be able to add that on. I mean, even for a small amount, it can really pick up their margin and their premium level very quickly. And
it gets people out of uncomfortable discussions. We had water hit, what hit first, and then you want to have that conversation with your insureds. I mean, that's going to look really old school in a hurry. So as soon as we've got the math and the data and the geo stuff to be able to do this well, and we're big believers that we're already there, fully there. So we think the conversation is shifting, and it's really a momentum play about how fast the insurance company can move away from kind of same as last year mentality to, yes, this is a clearly something we can wrap our heads around from a model, a data, a people, a process perspective. Why would we leave the margin of the customers on the beach when we can do the right thing, make money at it, and have better customer service? Why would we just buy? Because 10 years ago we were uncomfortable. I mean, it's not a great answer.
Yeah, but data's changing everything. So Jim, do you have a slide after the one we're seeing where you list some of these resources that you've quoted?
I do. Let me pull that up. Thank you. We were having such a good conversation. I just didn't want to stop it.
I know, same here, but I just know some people probably need to sign off right at 1:15.
Well, yeah, we are hitting the wall, so I wanted to just remind everybody that.
So I put these together. This is kind of my list. So this is not an official Milliman list, but this is my list of things that I think about that could be helpful for flood. And I wanted to make sure that you folks, if you wanted to do smart digging, would have some information. FEMA's got some really good articles on this, and already what's changed in their plan. So there's some good reading there. The North Carolina Rate Bureau has done some very interesting work with us and has an offering for their whole state to people to plug into. Their insurance companies can just pick that up. There's a national conference coming up, the Flood Virtual Conference, and there are some really smart people that are running that, and we think that's going to be just stellar. And then we have some thought leadership pieces on flood, so you can link and look at any of those. But the other thing is that, I think sometimes we think of technology as what you buy in a product, but I think the technology, the know-how is actually embedded in people. And Carol, your education comment is prescient. I think too, it's changing so fast that it's hard to sort of can an offering because it's just so dynamic. And the flood models we're using now are not going to be the flood models we're going to be using in 5 years. So everything is changing pretty rapidly. And even our first, one of our big customers that we're working with, how we started them in their first states on flood is not how we're doing it now. And there's a lot of commonality, but there's also some real change. And this is live. So I think that if anybody wanted to have a conversation in an insurance company around their context, it's not just the flood offering that's hyper local. I think the strategy for flood is hyper local. Like if you're progressive and have ASI and you're an analytic driven company and you're going after the customer share wallet, that's kind of one lens. The lens that a Nationwide would have, or that a Farm Bureau might have, or that a local MGA would have, they just vary. So if you wanted to get into the conversation, we could jump in. If you have others you want to have that conversation with, great. But I would just take half an hour, take an hour, lay out what you think you might want to do, and just spitball it, because I think this is a very doable one. And I think sometimes the hardest thing is just to get into the right conversation around that insurance entity and what is the smart play given where you're starting from and where those leaders want to be, the appetite, the culture of that group. And I don't think it needs to be a hard conversation. It just needs to happen. If we were smart, we would pay people to have those conversations, because those are the crucial, in my mind, those are the crucial first thing that really has to happen. And I think, was it Dave? One of the guys, one of the broker guys was, it was Rick Walsh, talking about the partners too. And I think it can't just happen with one part of the insurance supply chain. I think it could start with one, but quickly it needs to include two other partners, at least one other, if not two.
Well, and the brokerage channel may be the way to get that conversation started, because they can bring those different parties to the table if there's a need. Thank you very much, Jim and Dale, that you wrap it up. But I know I, for one, would love to get your slides as well as the recording of the meeting. So I'll let you wrap us up, Dale. You're on mute.
I'm a bad Zoomer. I do want to thank everybody for joining us. This was a great topic, and one that I did the work on it because I firmly believe in where Jim and Milliman are going. And I think it's an interesting topic, and it's one that's got both actuarial, insurance, as well as political ramifications, as well as, human ramifications that are very important to all of us. So James, thank you so much for your hard work. I'll get back with you later on how we can share the recording and the slide deck. And I want to thank my team for your support as always. Thank you.
You're very welcome. Thank you very much for all of your engagement, and I'll send over the slide deck and also fill in the full answers from this team in terms of where your interests were at. And I'll probably also put Dave Evans' stuff on the back of it too, because he made some good contributions in case people wanted to follow up directly with Dave.
Yeah, terrific. Thank you so much.
Thank you, sir.
Thank you, everyone.
Thank you for the invite to a non-chapter member. Appreciate it. It was a
Oh,
great presentation.
no, you're always welcome, always.
Dale, good to see you. Rick, if you're still on, good to see you. Maybe see you in Orlando.
Yeah, well, I know I'll be there, Roger, so it'd be nice to shake your hand.
I might do it.
Thanks, everyone.
Thank you. Bye now.
Bye-bye.